Searching for the most profitable strategy is a bit like looking for the best tool in a shed. It depends entirely on what you're trying to build and how much weight you can carry. In 2026, market volatility and the rise of AI-driven execution have made adaptability more profitable than any single fixed setup. However, based on statistical performance and institutional adoption, 3 strategies consistently lead the pack for retail and professional day traders. 1. The opening range breakout, ORB. This remains a favorite because it capitalizes on the massive influx of volume and price discovery during the first 15 to 30 minutes of the market open. The logic: you define the high and low of a specific time window, often 5, 15, or 30 minutes. When the price breaks out of this range with high volume, you ride the momentum. Profitability stats. Success rates typically hover between 40% and 60%. The profitability comes from the high risk-to-reward ratio, often 1 to 2 or higher, as opening moves tend to be the most extended of the day. Best for traders who want to finish their workday by 11 a.m. The opening range is the high and low price established during a specific time frame immediately after the market opens. Common time frames: 5-minute, 15-minute, or 30-minute ranges. The setup: you mark the high and low of that candles. The trigger: a candle closes above the high, bullish ORB, or below the low, bearish ORB, of that initial range. 2. Strategic execution. A successful ORB requires more than just a price cross. It requires confirmation to avoid bull traps or fakeouts. Volume confirmation. The breakout candle should ideally have higher relative volume than the candles within the range. This indicates institutional participation rather than just retail noise. The VWAP filter. For a bullish ORB, the price should be trading above the volume-weighted average price, VWAP. For a bearish ORB, it should be below. VWAP acts as the equator for the day's trend. Multi-time frame alignment. Check the daily chart. Is the stock breaking out of a 15-minute range and also breaking out of a daily resistance level? That alignment significantly increases the probability of a trend day. 3. Risk management and profit targets. The beauty of the ORB is its mathematical clarity. Since you have a defined range, your invalidations are built in. Stop loss: asterisk conservative, placed at the midpoint of the opening range. Aggressive, placed at the opposite side of the opening range. Profit targets: asterisk target 1 to 1x the size of the range, 1R. Target 2 to 2x the size of the range, 2R. Trailing: many traders move their stop to break even after target 1 is hit and trail the rest using a 9-period EMA or VWAP. 4. Mathematical example. If a stock has an opening 15-minute range of 150.00 high and 148.00 low, the range size, $2. Entry: buy at $150.10, breakout. Stop loss, $148. Risk is $2.10 per share. Target 1, 152.20. 150.10 plus $2.10. Target 2, $154.30. 5. Why traders fail with ORB. The strategy is simple, but the execution is difficult due to 2 main factors. 1. Chasing. Entering too far away from the breakout point, which ruins the risk-to-reward ratio. 2. The first 15 inches trap. The first 5 minutes of the market are often incredibly volatile. Many professional traders wait for the 15-minute or 30-minute ORB to allow the noise to settle, providing a more stable foundation for the day's direction. Pro tip: in the current 2026 market environment, false breakouts are common. To counter this, some traders use a breakout retest entry, waiting for the price to break the high, come back to touch it as support, and then bounce. 2. Mean reversion, the rubber band strategy. While momentum is flashier, mean reversion is often more consistent in the long run. It bets that price extremes are temporary, and will return to an average, like a moving average or VWAP. The logic: using indicators like Bollinger Bands or RSI, you identify when a stock is overextended. You short the top or buy the dip, targeting a return to the mean. Profitability stats often boasts a higher win rate, up to 65 to 70%, but requires disciplined risk management because the trend can remain irrational longer than you can remain solvent. Best for choppy, sideways, or range-bound markets. 3. Volume profile and order flow trading. Instead of looking at just price, this strategy looks at where the big money is actually transacting. It identifies high volume nodes, HVN, price levels where the most shares have changed hands. The logic: you look for value areas. If the price breaks out of a value area, it's a signal of a new trend. If it hits an area with no volume, a liquidity void, it's likely to move through it very fast. Profitability stats, highly regarded by institutional traders for its edge in seeing where supply and demand are truly imbalanced. While most indicators, like RSI or moving averages, are based on price and time, volume profile and order flow are based on price and volume. This is often called trading in 3D because it shows you not just where the price went, but how much conviction was behind the move. 1. Volume profile. Horizontal volume. Standard volume bars at the bottom of your chart show when trades happened. Volume profile shows at what price they happened. It creates a histogram on the side of your chart, point of control, POC, the price level with the highest traded volume for the day. This is the fairest price where buyers and sellers agreed most. Price tends to act like a magnet to the POC. Value area, VA, the price range where 70% of the day's volume took place. Value area high, VAH, and value area low, VAL, act as dynamic support and resistance. High volume nodes, HVN, speed bumps, where price slows down and consolidates because there is a lot of historical interest here. Low volume nodes, LVN, liquidity voids, where price moves very fast. If price enters an LVN, it often zips through it because there are no resting orders to stop the momentum. 2. Order flow, the footprint chart. If volume profile is the map, order flow is the microscope. Instead of seeing a simple green or red candle, a footprint chart shows you exactly how many contracts were bought at the ask and sold at the bid inside that candle. Imbalances occur when there are significantly more aggressive buyers than sellers, or vice versa, at a specific price. On a chart, these often highlight in yellow or bold. Triple aggressive imbalances often signal a strong trend start. Delta, the net difference between buying and selling volume. Positive delta, more aggressive buying. Negative delta, more aggressive selling. Absorption, when price hits a level and aggressive market orders, large delta, fail to move the price. This means a hidden limit buyer or seller is absorbing all the pressure, often a sign of a massive reversal coming. 3. Strategy, the value area trade. One of the most profitable ways to use these tools is the value area play. 1. The setup price opens outside of yesterday's value area. 2. The trigger. Price moves back into yesterday's value area and closes a 15-minute candle inside it. 3. The target. Statistically, there is an 80% chance price will travel across the entire value area to touch the other side, e.g. from VAAH. 4. Why this works in 2026. In a market dominated by algorithms, price action can be manipulated, fakeouts. However, volume is truth. An algorithm can move the price with a small order to trigger your stop loss, but it cannot fake millions of shares of volume without leaving a footprint on the profile. Summary comparison. Tool. Focus. Primary goal. Volume profile. Horizontal volume. Finding fair value and key support/resistance. Order flow. Intraday aggression. Seeing who is winning the battle right now. Level 2. Resting orders. Seeing where the walls of money are sitting. Time and sales. Executed trades. seeing the tape speed and size of orders. The learning curve. These are pro tools. They require specialized software like Sierra Chart, Bookmap, or NinjaTrader, and a data feed that provides tick data, level 2. While the learning curve is steeper than learning a moving average, it provides the most objective view of the market possible. Most traders who master order flow never go back to naked charts because they feel like they are trading with the lights turned on. Scalping is the high-frequency wing of day trading. Unlike trend following, which seeks to capture a mile-long move, scalping is about capturing an inch, but doing it dozens or even hundreds of times a day. In the 2026 trading landscape, scalping is heavily influenced by order flow and liquidity, as traders try to profit from the spread or tiny fluctuations in price. 1. The core philosophy. Scalpers operate on the belief that it is easier for a stock to move 5 cents than it is for it to move $5. Duration trades typically last seconds to a few minutes. Volume. Scalpers often use larger position sizes to make small price movements financially meaningful. Frequency. A scalper might take 20 to 100 trades in a single session. 2. Primary scalping techniques. A level 2 and tape reading. Order flow. Scalpers rarely look at 15-minute charts. They live on 1 minute, 30-second, or even tick charts. The logic. You watch the level 2 inches, the order book, to see where big buy orders, bids, and sell orders, asks are sitting. The trade. If you see a massive buy order at $100, you buy at $100.01, betting that the big wall of buyers will prevent the price from dropping, allowing you to sell at $100.05 for a quick scalp. B. Micro pullbacks. The 9 EMA scalp. In a fast-moving market, price often hugs the 9-period EMA. The setup. A stock is in a vertical move. Every time it touches the 9 EMA on a 1-minute chart and wicks, bounces, the scalper enters. The exit. The moment the momentum stalls or a single candle closes against the direction. See arbitrage and spread scalping. This involves playing the difference between the bid, what buyers pay, and the ask, what sellers want. The trade. If the bid-ask spread is 2 cents, a scalper might try to buy at the bid and immediately sell at the ask. This requires extremely low commissions and high-speed execution. 3. The scalper's toolkit. To be a successful scalper, your technical setup is often more important than your feeling about the market. Hotkeys. You cannot use a mouse to trade. Scalpers use keyboard shortcuts, e.g., Shift+B to buy 1,000 shares at the ask, to enter and exit in milliseconds. Direct market access, DMA. Scalpers bypass standard routing and send orders directly to exchanges like Arca or Nasdaq to get the fastest possible execution. Low latency, a fast internet connection, and a high-performance PC are non-negotiable. Even a 100 milliseconds delay can turn a winning scalp into a loss. 4. The pros and cons of scalping. The good. The challenging. High win rate, often 70% or higher. High stress. Requires intense focus and fast reflexes. Limited exposure. You are in the market for such a short time that black swan events rarely hit you. Commission heavy. Trading costs can eat 30 to 50% of your profits if you don't have a high volume tier. Many opportunities. You don't need a trend day to make money. The fat finger risk. One accidental large order or missed exit can wipe out 10 successful scalps. 5. Risk management. The tight leash. In scalping, the stop loss is usually very tight, often just a few cents away from the entry. Hard stops. Some scalpers use automated stops. Mental stops. Most elite scalpers use time-based stops. If the trade doesn't move in their favor within 30 seconds, they exit regardless of price. Is scalping for you? Scalping is best suited for traders who are 1. Decisive. There is no time to think or wait and see. 2. Statistically minded. You are playing a numbers game, not trying to be right about a company. 3. Well capitalized. Because you are going for small moves, You need enough capital to trade large blocks of shares while still maintaining a safe risk percentage. Comparison of the 4 main strategies. Strategy. Time frame. Typical win rate. Effort level. OARB. 15 to 60 minutes. 50%. High. Morning only. Mean reversion. 10 to 30 minutes. 65%. Medium. Trend following. 1 to 4 hours. 35%. Low. Patient. Scalping. 10 to 120 secs. 75%. Extremely high. The hidden variable. Risk management. No strategy is profitable without a mathematical framework. Most successful traders in 2026 adhere to 2 strict rules. 1. The 1% rule. Never risk more than 1% of your total account equity on a single trade. 2. R multiple focus. A strategy with a 40% win rate is highly profitable if your average win is 2x your average loss. 2R. Note on 2026 regulations. As of March 2026, FINRA has moved toward an intraday margin framework that replaces the old $25,000 pattern day trader (PDT) floor with risk-based requirements. This allows for more flexibility, but makes position sizing even more critical to avoid blowups.